Welcome to 7 Investing Now, a show that teaches you how to take a long-term view on investing by better understanding what's happening in the market now.
Good afternoon and welcome to the Friday edition of 7 Investing Now. My name, of course, is Daniel Brooks-Klein. I am the host of the program. Going to be a bit of a special program today. We are talking about investing internationally with Anirban Mahanti. Anirban, as you may know, lives in Sydney, Australia, and all of us at 7 Investing follow investments all around the world, but he has some really unique perspective about sort of how you make those investments, what the red flags are, and where you need to be looking. So we taped this interview a couple of days ago. Feel free to ask some questions while it's going on. I'll come back at the end and say goodbye. But if JT Street, if you want to hit that interview, it is me, it is Anirban Mahanti. Thank you. Anirban Mahanti, welcome to the program. So we talked about this a little bit off air. Before we get to talking about international investing, you have come out of lockdown and you can actually travel relatively soon. Am I reading that correctly?
Well, yeah, I was able to travel in my car over the past 2 weekends and go more than 5 kilometers. But you know what I discovered, to my great annoyance? I traveled 45 minutes to go to the beach, and I spent exactly half an hour trying to find parking. And I also now know that I had forgotten about all the tailgaters that exist in Sydney. Everybody tailgates. It's like, life is not that good. People are tailgating me. I can't find parking. But yeah, you can travel more than 5 kilometers. Yeah.
We're just starting to see the return of like normal traffic. Like there's more offices that have opened here. So while a lot less people are going to work, there's like triple the office space. So there's more people on the road. Like this morning, I went to a new coffee shop just because I wanted to try something different. And it was 3 miles away and it took me like 18 minutes. And like, I would have been able to do that in 3 minutes, like a few months ago. The one thing I will say here is you have a bunch of beach options. Like Florida is nothing but coast. So I can go to Palm Beach and that's where like the rich folks live. That's $5 an hour to park. Or I can go to any of the cheaper beaches where parking is plentiful and cheaper. My challenge is once you've spent time in the Bahamas, Florida beaches just don't seem that nice anymore. And I spend a lot of time in the Bahamas, but that is not, well, it is sort of what we're talking about. We're talking about investing internationally. And this is investing in companies that aren't headquartered, that aren't based in the US. But Anirban, why don't you define that a little bit? Because it's not always super cut and dry.
Yeah, so like the couple of different things, right? So a company, for example, could be headquartered in Australia, maybe in Sydney, but actually could decide to list in the US, right? So you could find a company listed in the US on NASDAQ or New York Stock Exchange, which is actually a foreign company in the real way. So a great example is Atlassian, right? The greatest software export from Australia. It decided to list overseas. So that's an example of a foreign company. The other extreme of a foreign company would be a foreign company that is not listed in the US and is headquartered somewhere else. Another great example for that would be Afterpay. I'm just using Australian examples because, I'm from Sydney. So the Afterpay, it's now being acquired by Square, but Afterpay is a company that is headquartered here in Australia, listed on the ASX. So a couple of different things to think about. Now, companies could be listed overseas, could be listed in the US, but their headquarters are overseas. That's one thing to think about when you're thinking about foreign companies. The other thing to think about is often, this is another thing that happens quite often, is you have a foreign company. So think about Alibaba. Its primary listing is in Hong Kong, let's say. It might have what's known as American depository receipts. So these are basically, you quarantine some number of shares with a bank, hold them in trust, and then that results in issuance of some number of shares that then trade on the American market. So it's you actually have physical stake in the business through this depository receipt that's held in trust somewhere at a bank vault or something like that, or in an electronic vault. And then you can trade on those ADRs, or you can buy those ADRs. So Alibaba is a great example. Tencent is another great example. I believe Tata Motors from India, for example, you can buy the ADRs in the US, I think in New York Stock Exchange. And then the final thing to keep in mind is when companies do ADRs, some companies actually also look at that as an opportunity to raise money, right? So you might create a secondary listing of a company that has a primary listing, say, in another market, let's say the Indian market and Australian market, but you use the secondary listing as an opportunity, secondary listing in the US as an opportunity to raise funds. What this does, though, is creates basically the same stock being listed in two different places, and you'd expect them to trade relatively close to each other. And the reason they would trade close to each other is otherwise there's an arbitrage opportunity. One person manager, a fund manager could buy here, sell it there, and basically mix and match the share. So you would expect them to trade pretty close to each other. So that's something to keep in mind. Last point is, in this one, I don't know the mechanics of how exactly it works, but I've seen many companies that don't have ADRs, they have over-the-counter trading via pink slips. Again, theoretically, they should, so Afterpay, I think Afterpay, for example, had something that was trading over-the-counter in the US. Theoretically, these should trade pretty close to the actual stock trading, whatever it is happening. But what tends to happen, though, is that some of these over-the-counter things, they can be illiquid, and then you might see actually quite a fair amount of gap. So different ways of doing this. Did I cover everything, Dan?
Well, let me ask one more question. How do you define a company like Sony? So a company that I think their headquarters is Japan, but they have a significant amount of business and presence in the United States. They are traded on the New York Stock Exchange, but they're not an American company, right? Like Sony, you'd have to say, is a Japanese company. Yes.
So Sony is a perfect example of a company like Atlassian in that sense, right? So it's a company that is trading. I don't know whether Sony actually has a primary listing in Japan. Probably does. I'm not 100% sure. So those are multinationals, right? So, I mean, that's the other thing to keep in mind is that, if you buy Procter & Gamble, that you're not buying an American company, really, you're buying a multinational. And that's the reality for, I think, a lot of consumer electronics, a lot of consumer discretionary, even if you're buying Ford, right? Is it, yes, they sell a lot of vehicles in America, but they sell a lot of vehicles elsewhere as well. So, I mean, that's the other reality is that companies these days are global. Unless your company is very niche, you're likely a global company. So you are a multinational company. So there's a lot of different ways in which you can define foreign in that sense, right? So, yeah.
So when you look at a company that's not primarily doing business in the United States, you brought up Mercado Libre in our notes, but obviously there's lots of examples of companies that don't base their business in the US. What do you look at? What's your prime considerations for how you sort of judge whether that company is investable or not?
Yeah, so that's a fantastic question.
You wrote it, so that makes it.
I'm calling my own questions fantastic.
Sorry, it's a joint effort, but I think you did actually write that.
Yeah. So a couple of different things, right? So as you rightly pointed out, right? So Sony is an interesting example. It's an international company. It's a global company. Global companies in many ways are easier to invest or understand, right? Because irrespective of where you are as an investor, you probably have some exposure, especially if it's a consumer-facing company, right? People understand what Sony does. People understand what Apple does. People understand what Procter & Gamble does. People probably understand what Heinz does, right? But if you have a company like Mercado Libre, which is basically focused on Latin America, it's a marketplace business in Latin America. It's like an Amazon of Latin America. It's like an eBay of Latin America. It's like a PayPal of Latin America. Then you really don't understand, because if you're not in Latin America, you don't really see the business in action. You're not really using it. So that makes it hard to invest. But I think some of the big opportunities also tend to happen in those sort of scenarios, right? So what do I look for? I try to think about the problem they're solving. And this is like, it sounds like a big buzzword, problem they're solving, some big thing that they're doing. Often the key there, in my opinion, is to, think, okay, we're building a marketplace that is focused on international markets in like Latin America. But what is special about the marketplace in Latin America? I think that's the question one needs to think about, because marketplace business in the US is probably going to look very different from the marketplace business in India, which is going to look very different from the marketplace business in Latin America. So I try to think about the problem that they're solving and what are the specific issues that they're handling that are very relevant in the local environment. So I'm talking about companies that are not Global in the real sense. A global company you evaluate, I think, you would evaluate it. But for specific emerging markets or location-specific markets, or the same thing would apply to a company like Alibaba or Tencent, right? You really have to understand their local market where they're operating and the dynamics of the local market. So I try to think about that. Then, of course, all the other things come into play, right? So I would look at, the management is whether, management have skin in the game. Do the management continuously dilute their shareholders? Are they reporting standards? Do they have good reporting standards? Do they actually report honestly? Do they have a long-term vision? All of those things, I think the standard things that we look for in investing, I think those come into play. But the problem that they're solving and the opportunity to have long-term staying power, right? Can they build a moat? Can they, no business starts with a moat, but can you build a moat? Can you have and if you're building a moat, can you actually strengthen it over time is what I'm trying to think about. So that's sort of, and of course, I guess the most important thing to think about is I look at, this is my way of investing, and not everybody will invest this way, but I look at market size or market cap of the company versus the TAM, right? If the TAM is niche, it's probably going to be a subscale company, not interesting. If the TAM is huge and the company's market cap relative to TAM is relatively small, then that's a company that's of interest to me, because otherwise there's so many different companies that one can invest in, right? Why try to invest in something that's hard if the upside is not there? So that's the, I try to think about the upside really in these.
TAM, for those who don't know, is total addressable market. But let me ask the question. So I've lost a lot of money. I mean, an astounding lot of money by not investing in Mercado Libre. Like, I have multiple friends, people who are big fans of this stock. And here's why I didn't invest. I understand that their core business isn't so much the Amazon side of it as it is the banking side of it. They are operating in countries where people are unbanked, where the money system isn't as stable, where they're sort of providing sort of the full scale, like they're the bank, they're the clearinghouse, they're everything. But I don't know how big a problem that is. I know it's a huge market, but I don't know what political problems they face. I don't know what resistance. I don't know if there's little criminal elements fighting against that. And that always sort of kept me from investing, because if you tell me when T-Mobile launched its banking product, which I think has largely been a failure, but my wife could tell me the exact amount of Americans who don't have a checking account and how many of them are T-Mobile customers, and I could see the need and go, okay, that's a good idea. I can't do that because as much as I'd love to go boots on the ground all over the world and talk to a lot of people, that's very impractical.
Yeah, so that's a great question. Look, so I think I sympathize with that view, because so I have been a Mercado Libre shareholder for a long time, and it's been really a fantastic company to invest. But does every company turn into Mercado Libre? No. The answer for that is absolutely no. There are many companies that go bust, right? I had invested in, Lucan Coffee. That really did not work out very well for me. And
this is the third. This is the third show in a row that Luckin Coffee has come up, and I always resist the urge to gloat and point out that I was negative Luckin Coffee for business reasons, not for suspected fraud reasons. And no one, myself and Emily Flippen, nobody else agreed with us. And we had to be very quiet when that all went bad, because the reason we thought it was going to go bad was obviously not that they were lying about all their numbers. But yes, that was an ugly one.
Yeah. So like there were many instances, JD.com, which, I had invested in that didn't really work out. There are a few others that, Bilibili. Here's the thing. I think it depends on investing style, really. Because when I am looking to invest in a company that operates outside of the main, the main global markets, like in a specific, which is, let me rephrase that. It operates in a specific market, right? So operates only in China or in Latin America or only in India. Then the only reason in my mind, I guess, to invest is the upside. So there really you have to think about the upside and the TAM and things like that. And you have to acknowledge the risk exactly as you're saying, it's hard to know what problem is Mercado Libre solving, right? It is solving a marketplace problem. It is, and the unbanking is a huge deal. I don't know, because I'm from India, I think one of the things that I realized is companies that can solve, one of the common pitfalls for us to think about is it's very easy to make this assertion that because Amazon is very successful in the US, somewhat less successful in Europe, it's going to be very successful, say, even in places like Australia or in India, right? that is not necessarily true, because one of the problems that happens with companies that are extremely successful elsewhere is that they think that the same business blueprint can be applied in other markets. And often, if you are not willing to change that blueprint, you can have opportunities for other companies to succeed. So Flipkart, for example, succeeded very well in India because it had a different approach to the market. Well, Amazon is also pretty successful in India, but Amazon is not that great successful, for example, in Australia, right? We have local competitors that have taken its place. So I think, going back to your question, I really think about the upside, and if the upside seems large, then I invest, fully acknowledging that the downside is there. But if the upside is large, then it's probably worthwhile, because again, I like to say that downside is 100% if you land up with luck and coffee, but upside could be several thousand%, right? So if you land up with a Mercado Libre, so it's a riskier way of investing. I'll fully agree with you there. And
yeah, I mean, Mercado Libre is either going to be very successful or it's not going to work. And obviously the last few years suggest it's going to be really successful. And it's funny, when you just brought up companies approaching things differently, I hate to give Facebook a ton of credit, because obviously that's a company that doesn't do everything right from a privacy point of view. But from a global point of view, the product Facebook is trying to deliver in the developing world is much more about connectivity than it is about advertising and sort of all the things we do. So that seems to be a company that's fully sort of acknowledged the idea that, yeah, in parts of the world, Facebook is the internet to people, and they have to operate in a different way they do in the US. Can you think of some others? Microsoft would be another one that I think has done pretty well globally.
So I'll take a little bit of different view on the Facebook. I think Facebook has done a fantastic thing with WhatsApp, right? So WhatsApp was a fantastic acquisition that Facebook made, and it's turned really WhatsApp into a communication platform that is, like, for example, in India, it's totally glued in to people. I think they're not doing it for any other reason but advertising. They're doing it for purely for advertising reasons, but it's a great play because it creates this network effect where, people have WhatsApp. Now the stores have WhatsApp. Every shop has WhatsApp. Every trader has, like every handyman has WhatsApp. Everybody has WhatsApp, and it has become the default communication platform. I think that's a great play because it creates this network effect, right? So it's basically playing on network effect. And then that sort of translates to overseas people. I need to use WhatsApp because so many people are on WhatsApp in India that I need to communicate with. So even if I don't want to use WhatsApp, I'm forced to kind of use WhatsApp, at least on an occasional basis. So I think that's a great example of network effects at work. So some companies are able to exploit opportunities brilliantly, right? I would have expected an Android platform-based something to have taken that place, not WhatsApp. But but I think you're right in that.
It's very hard to dislodge once something is there as a basic communication. It's like if you told me that a lot of people globally were going to use WhatsApp instead of text messaging, I would have said that's crazy because text messaging is so easy, but it isn't necessarily international based on how plans work and I know I have an Instagram account because some of my friends in Europe, that is the easiest way to communicate with them. I don't even know how Instagram works. I don't use it for anything other than messaging. I'm kidding a little bit. I know how to post a picture. I'm not dumb. But, so yeah, you have to look at the opportunity. And obviously, one of the things you mentioned that I thought was interesting is some of these companies can fly under the radar. So is there an opportunity to sort of identify companies like really before they're getting a lot of news coverage?
Yeah, so Mercado Libre is a perfect example, right? So if you were looking at Mercado Libre in say 2010, it was very much under the radar, right? It was a much smaller company than it is today. That's an opportunity in many ways. In general, if you look at sort of that sub, 10 billion market cap companies, those tend to go under the radar, and there is an opportunity definitely there, right? And the advantage I think with under the radar companies is just less coverage, right? Less coverage, less number of analysts following it, therefore, fewer price targets, fewer opportunities for, the wider Wall Street to know about it, less following. That creates a lot of volatility. And it also creates, I think, a price arbitrage opportunity for sort of the long-term investor, right? If you believe that the company is not being properly valued, then you can sort of take that opportunity to invest ahead of the curve, right? And you have to be fully acknowledged that there's going to be a lot of volatility in it.
Yeah, and even for a company that's following SEC rules or SEC-like rules in its reporting structure, if there's less people on that earnings call, there's less questions. And one of the things I've noticed in reading an earnings report that oftentimes the newsiest thing is like the last guy who asks a question during the conference call. There are a lot of companies that don't have anyone on those calls or only have one or two people on those calls. That might be a little too close to the company. Let's ask one last question before we start to wrap this up. We're going to talk about red flags in a minute, but I want to talk about political risk. So we've seen with China some, I would argue, arbitrary, but I think an expert on the Chinese government would not say arbitrary, but there's been a crackdown on some pretty giant platforms. And then there's been some others that haven't been able to go public because the government maintains a very strong role. But that role's been a moving target. The rules are not, not that things don't change here in the US, but it's difficult for things to change and they don't tend to move quickly. And we've seen some pretty quick changes in China.
That's yeah. So I think this is not just a China thing. This is I think the sort of the developing versus the developed economy situation, right? I mean, in the developed markets, whether or not Apple is a monopoly is going to be discussed for a decade before, you come to a decision as to whether it's a monopoly or not. By the time actually you decide whether it's a monopoly or not, probably if it was a monopoly, the monopoly is gone. and if it was not a monopoly, by the time maybe it is a monopoly. So I think the institutions that look at these things are slower moving. In many other places, there's lack of that sort of institutional, I guess, oversight, or multiple institutions that have to oversight things, and therefore there can be more unilateral decisions. There can be government changes that result in significant changes in how businesses operate, right? Great examples are like, in India back in the 70s, I think the government basically just nationalized stuff. Right? So you're like a forced seller. That's not a good position to be in if you're a forced seller. So those sort of things can and do happen, right? And so that's why I rate them as a higher risk. So political risk is very high in many places. That's something to again fully acknowledge. This is not fraud related. This is like and the same thing, like for example, the stuff that's going on with Alibaba and so on. Some of that, I mean, could make absolute sense. So technically it makes sense that Alibaba, for example, might not be able to impose these restrictions on merchants that say, okay, you can only sell on the Baba platform or whatever, and not nowhere else. Or if you do, then we're going to, do something, right? That sounds anti-competitive, and therefore the government coming in and trying to stop it seems to be the right thing to do. But here's the deal, right? This thing has been going on for many years. So it was okay then, it's not okay now. So it's hard to, I guess, speculate based on, or hard to extrapolate based on past growth. Like as an analyst, we look at what has happened in the past as sort of a guide to what may happen in the future based on the time and things like that. But you may not be able to do that. So I think that's something to consider. I guess the bigger question you're trying to ask is that a deterrent for people to stop? I think stop investing. And I think the answer to that would be, it really depends on your risk tolerance, right? I mean, if your risk tolerance is low, probably steer clear, right? I mean, and the thing is that everybody doesn't need to go and venture there, right? So this is a higher risk for sure. I mean,
right. And I think on some level, you do need to understand the bigger picture. So you mentioned like nationalizing, and people ask me all the time, like, what if China was to nationalize Starbucks? Well, China wants global investment. And if China was to nationalize Tesla or Starbucks or whatever else it might be, then other companies aren't going to invest there. And I think that's a pretty simple equation. Now, could Venezuela decide to nationalize like some US businesses? Yes, because the ramifications aren't the same. And the leadership is perhaps not as long term. So you have to sort of be a student of the world, of the globe. And I'm not saying there's no risk in China of that happening. Obviously, there could be, I don't want to say regime change, but there could be thinking change within what the government is that decides, no, we don't want this money, or we don't want these American companies. And Disney's been the beneficiary and suffered from this sort of ever-changing desire to have American movies or not have American movies. But that being said, what other red flags? We'll close with this. What other red flags should I be looking for if I'm going to invest in non-US companies? And I really haven't. This is an area lacking in my portfolio.
Yeah, so I think the biggest red flag is, well, this is like a red flag from an investor's point of view, right? So in investors, we are always looking for alpha, and in the hunt for alpha, one might find, oh, this business is growing really quickly. Nobody's really paying attention to it, but it could be that it's growing quickly because it's subscale. Like, when you were talking about giving an example, saying, well, it's easy to grow from four subscribers or 4 users to like 8 users to like 16 users. That sounds like a very fast growth, but it is growing from a very small base. So I think consider the base, and then consider the scale, right? I mean, maybe you have 10 million users in a platform today, but is the ceiling 20 million? Well, then that's a bit of a problem, right? The other thing, this is not talked about a lot, but I've seen this when I was, by following small cap, especially following micro cap Australian stocks. On the surface, a technology will appear great, and maybe the technology is actually great. The opportunity sounds large. But often what happens is, if the business started off with the wrong pricing plans and the wrong structures and the wrong sort of the business go-to-market strategy is probably the right word. Once you've started on a bad footing, it's very hard to get out of that bad footing. And classic one that I've seen is poor pricing. Like if you design a product and it's a subscription, let's call it a subscription product, and let's say it's like streaming, right? And you start a streaming service at $2.99. You're going to have a hard time taking it to $19.99 in 5 years. It's really hard because the subscriber base really has this expectation built in that, well, it's $2.99. Maybe you can make it $3.99. Maybe you can make it $4.99. Beyond that, maybe it's going to be really hard, right? So I think knowing your product and knowing the competition and knowing how much you can charge for it is a skill. And a lot of smaller companies, I think, go into the pitfall that, we need to survive, we need to get free cash flow, and for that, if this pricing is okay, but then basically you have cut your TAM in maybe 1/10 because you didn't actually charge what you could. So this is one thing. The other thing is, of course, scale. Sometimes you could just be a subscale business, and that's, again, not maybe of interest.
And we've seen that pricing issue with some very established companies. I'll give an example of a product I love that was way overpriced. And I think it killed its market reach, and that's the Microsoft Surface. So when that first came out, the base model was more than a comparable iPad, and you needed all the accessories. You needed the keyboard, you needed the cover. So all of a sudden I could buy an $80 Amazon Kindle that does all the entertainment things. I could buy an iPad that does all of the business productivity and all the entertainment things. Maybe that iPad would be $399 or $499. Or I could spend $900 and buy a Surface. And I was lucky enough, I worked at Microsoft, they sent me one. But that being said, that product was dead in the water. And I think we've seen, and not dead, it's done okay, but it really could have been a new form factor. And we've seen that. And I guess there's a difference between something like, say, like an Oculus or a HoloLens, where the goal is to like start at a premium and then eventually make it a mainstream product. Or like if you come out with a new gaming console, I don't care how great your gaming console is. If it's $1,500, nobody's going to buy it. It can't possibly be $1,100 better than an Xbox or whatever it is. So pricing can hit at all areas. Anything else we should worry about as a red flag before we close the show here and you go have some coffee and I go have some scotch?
I love
it's like 3 o'clock here. That's it's actually way too early to have scotch.
Yeah. So we've talked about, I think we talked about the subscale thing. I think the regulatory framework is something that you need to understand. And sometimes it can be too complex to understand. That can be an issue. The other thing that is important to realize in certain markets, it's free market as such, but it might be that there is duopolies or quadpolies in place, right? So a great example would be banking, right? In Australia is basically like a 4-pillared banking system. We've got 4 big banks basically that rule the roost. And if you have to be a neobank that, you just can't be a neobank that comes from America and try to invade this market. This is going to be a tough market to invade and win because you've got established incumbents. So understanding sort of local dynamics and the play is important. So, while it sounds great to have, maybe Square and Afterpay, they're going to get together and change banking altogether. Well, it's going to take a long time to change banking, how banking is done in Australia, because again, the incumbents are not going to give way that easily. So often I find that it's easier to innovate and grow in new markets and new services, right? So new services because people don't pay that much attention, but it's very difficult to upstart not to be an upstart and disrupt an existing area which has got strong competitors. So I guess those are sort of some of the things to think about.
It's very difficult to beat an incumbent, and I'll give an example we talk about a lot. Square. There's huge growth for Square. I'd argue it's companies that didn't have a point of sale system that then added one, or new businesses. I don't think there are very many established retail businesses that decided to have Square as their principal. I can think of one. There's one coffee shop near me that their POS died and they went to Square, but it's a one location store. Their success has been attrition and growth and new businesses coming in. I don't know why you'd buy like an old school point of sale system when you could, buy a Square and outfit it cheaply. We're going to keep talking about international investing. We're going to, continue to try to grow our perspective on this and sort of break out of some of the America bias, because there are great opportunities all over the world. There are also risks and dangers here in the US and of course, all over the world. Anirban, I can see the sun coming up. So, go out, take your dog for a walk. We will see you back on 7 Investing Now. If not next week, certainly very, very soon.
Thank you.
Thank you, Anirban. Thank you all for watching. If you would like to get in touch with us, it is very easy to do. You can send us an email at info@7investing.com. That's questions about your membership, questions about becoming a member. And if you are not a member, what are you doing? Go to 7investing.com/subscribe. Use the code NOW. You'll even save $10 off of your first month. It is $49 a month. The best deal you can possibly get in investing. 7 unbelievably diverse, talented lead advisors, each giving you their highest conviction stock pick each month. If you would like to follow us on social media, we are at 7 Investing. That is at the number 7 Investing. It's Friday. I hope you all get to leave work soon. I know that's not the case for me. We have a busy afternoon here at 7 Investing, but that is not a problem because we love what we do. We will see you back here on Monday. Thank you, Anirban Mahanti. Thank you, JT Street. Bye.